Have you ever wondered how someone can make money from the market in just a few minutes? In this video, I'll show you how options trading actually works.
Just as quickly as an option can gain value, it can also lose value. That's why understanding risk comes before chasing profits.
Imagine putting $100 into a trade. A small market move can change the value of that position surprisingly fast. So before you put real money into the market, you need to understand what you're actually buying. Let's start with the basics. Trading simply means buying and selling an asset with the goal of benefiting from price movement.
For example, if you buy a stock at $100 and it rises to $110, selling it at that price creates a $10 gain per share, before costs and taxes.
That's the basic idea behind stock trading. But options trading works differently. With options, you're generally not buying the stock itself. Instead, you're buying an options contract, and that contract has a price called the premium. Now here are two terms every beginner needs to know: call and put. A call generally benefits from an upward-downward move. But remember, direction alone doesn't guarantee a profit. So what exactly is an option premium? Simply put, the premium is the price you pay to buy an options contract. Next, you'll see something called the strike price. This is one of the most important numbers on an options chain. But the intermixing numbers on an options chain. When the strike price is very close to the current market price, we generally call that at the money, or ATM. You'll also hear ITM and OTM. They mean in the money and out of the money, and they describe the relationship between the strike price and the current market price. Now let's talk about expiration. Every options contract has an expiration date, and that date matters a lot.
As expiration gets closer, time becomes more important. This is known as time decay, often represented by the Greek called theta.
Another major factor is volatility. When markets become more volatile, op premiums can change significantly. Now let's open the options chain. This is where you can see different strike prices, calls, puts, premiums, other important information.
But don't simply choose the cheapest option because it looks affordable. A lower premium can come with different risks and characteristics. Before entering any trade, decide how much you're willing to risk. A good trading plan starts with risk management, not with the hope of making a quick profit.
Once you open the options chain, don't rush to place an order. First, understand what you're looking at. The center of the chain usually helps you identify the current underlying price and the nearby strike prices. On one side, you'll find calls. A call option generally gains value when the underlying moves higher, although many other factors affect its premium. On the other side, you'll find puts. A put generally benefits when the underlying moves lower, again depending on price, time, and volatility. Before selecting a contract, look at the strike price, premium, expiration, liquidity, and the overall risk of the trade. Now let's talk about order types. A market order attempts to execute your trade at the best available price in the market. A limit order is different. You specify the price you're willing to pay, but the order may not execute if the market never reaches that price. Next comes position size. Never risk more money simply because a trade looks attractive. Your position size should match your risk tolerance.
Before entering a trade, know where you'll exit if you're wrong. A predefined exit plan can help prevent emotional decisions.
And one final beginner mistake: chasing the market. If you miss a move, let it go. There will always be another opportunity, but protecting your capital comes first.
Let's take a simple example. Suppose a stock is trading around $100, and after doing your analysis, you believe it could move higher.
You could consider a call option, but remember that this is only an example, not a guarantee that the market will move higher.
Now imagine the underlying price moves from $100 to $105. The call premium may increase, depending on factors like time and volatility.
If the premium rises from $3 to $4, the position has gained $1 per contract before transaction costs. But if the premium falls, the position can lose value instead. Now let's reverse the situation. If you believe the underlying could move lower, you might consider a put option.
Once your trading plan reaches its target, or your risk limit, you need to exit according to your plan, instead of letting emotions take control.
And remember, your actual result can be affected by commissions, exchange fees, regulatory fees, taxes, spreads, and other trading costs. Expiration is another critical concept. Options have a defined expiration date, and the value of an option can change significantly as that date approaches.
If you're a beginner, consider practicing with a paper trading or simulated account before risking real money. Your goal should be to learn the process, not to chase quick profits.
So that's options trading basics. Understand calls and puts, learn the options chain, manage your risk, and always have an exit plan. Protect your capital. If this video helped, subscribe for more finance videos.